Cost behavior patterns, this you recall from probably both your accounting and economics classes. We have the categories of variable costs, which is in direct proportion. So if we're selling gasoline, for every gallon we sell, we have a cost of goods sold for a gallon of gasoline, right? So that's a variable cost. Fixed are those that do not change. So again, if we're a gas station, the number of gallons of gas is variable cost, but the rent we pay for that piece of land or that the facilities, that's fixed cost. If we sold 1 gallon or 1,000 gallons, doesn't matter. It's the same amount. Mixed are costs that have a portion of both fixed and variable. An example might be like a utility cost where they charge you a minimum of, say, $100 a month for every thermal unit you use or every cubic foot of gas, your cost goes up. So that is an example of a mixed where there's a fixed portion and a variable portion. And step costs are ones where it's cost for a certain while, and then we add one more and it goes up another level. It goes again flat and up another level. Example would be shifts. If we manufacture our products comfortably in 1 8-hour shift, we're fine. But once our sales grow, we have to produce more than we can make in 8 hours. So we have to open a second shift. That one being from, say, 5 p.m. till 1 a.m. So that might be the evening shift. Then we might have the shift that goes from 1 a.m. to 9 a.m. That would be the graveyard shift. So in a production environment, step costs, an example would be a regular day shift, a swing shift, and then a graveyard shift. So those are examples of step costs. All right, variable costs look like that. Again, this should be largely review. Notice that the line goes through the origin because when you have 0 units, you have 0 costs. But as we move to the right with additional units of activity, our cost goes up by variable cost. And if it's a straight line, then the variable cost per unit is constant. You guys know that as slope, right? So the slope of this variable cost line is equal to the variable cost per unit. And we have this equation. You remember the equation of a line, y equals mx plus b. If it's only variable and there is no fixed component, it's just y equals m being the slope times x being the activity level or volume. Fixed costs is a little boring. It doesn't move. It's fixed. So whether you have 1 unit or 0 units or 1,000,000 units, the fixed costs are the same. So this one, there is 0 slope, and the equation looks like this. If it's y equals mx plus b, since there is no slope to the line, m is 0, so we're left with simply y equals b. Y equals the intercept, or the fixed cost. Mixed cost, as mentioned earlier, has both portions that are fixed, like here the dotted line, that's the baseline, and then we see the sloping line above it, and this one does have the form y equals mx plus b, where m equals the variable cost per unit and b equals the fixed cost component for this particular mixed cost item. Step cost is like the shifts we talked about, and this shows, in this case, four jumps, and this wouldn't be shifts because we can only have 3 shifts a day, but it might be things like baristas at Starbucks. If you're kind of slow, just starting up the store, you have 1 barista. As you grow, you hire another barista. And you can keep adding baristas as your Starbucks store gets busier and busier. So that's an example of step costs. Another example of step costs. Average cost is when you're very low volume, it's very high, but the bigger the volume, your denominator gets larger, and the average cost per unit is spread among that increased volume. So what we look at is an example here. If we have 100 customers, average cost 35, but as we go from 100 to 300 to 500, it drops from 35 to 15 to 11. So increasing sales has many, many valuable byproducts, but the main is that we're driving down our average costs, which will make us profitable. All right, so how can we reduce costs over time? And this is a generic list that can be used in many, many settings. One is labor efficiency. If you are better at doing a job in more work and less time, then you're going to lower the cost per unit of your function, whatever that function may be. If we're in a manufacturing environment, we could standardize or specialize or do different production methods. Those would drive down costs. We could also use technology in the factory to be more efficient and effective in how we manufacture our products. Scale, we can use equipment more fully. As we mentioned, as we move from 1 shift to 2 shift to 3, we're paying the same amount for the equipment, we're paying the same amount for rent. So our scale is going to drive down our costs. We can use the mix more efficiently. So you may start off with a lot of labor, but over time you could replace labor with some mechanized items to reduce the cost for manufacturing. Product redesign, you could look at an electric drill from like your grandfather. It would be big, heavy, full of metal. Over time, we've redesigned that product to have metal where it's necessary, like the motor or the housing for the drill bit. But we can substitute lower cost materials such as plastic for the housing for the drill. So redesigning the product will reduce our costs. Then we have value chain effects. So if we buy and source subcomponents or raw materials from people who have them, as they become more efficient, we benefit because the input cost to us also drops. Then there's the aspect of network building, we can reduce costs. For example, if we had an email account, but you're the only person that has one, it's worthless. You're not going to write email to yourself. So the network effect shows that as we grow the network, it has more and more power to us. And there are many examples of that these days because of the internet. And finally, shared experience. If we're really good at making one thing, it may mean we're good at making something else. Example here was Corning, which manufactured glass and eventually got into seeing that manufacturing fiber for transmission of data was very close to their core expertise. Another great example is Honda. Honda makes great engines, so they can make it for a motorcycle, a car, a lawnmower, a generator. Those all use the core competency of a motor. So CVP, cost volume profit, you've seen before, and we have certain assumptions that we have in CVP, and they are all costs are either fixed or variable, no mix. Second is that everything is linear, or at least in the relevant range. That makes the math easy. Third is revenue is linear. In other words, we don't change prices. We have the same price that we offer to everyone buying our product. Fourth is that we have a single product, or that the sales mix is very constant. We'll use an example of a single product to make it easy. And finally, there's only one driver. So the variable cost is based on one item, such as units. All right, so let's use the profit formula and just derive it so it is in your memory. First, we know that profit equals revenues minus costs, total cost. Simple. Next, we say revenues is a function of unit sales and price. So we now know that revenue equals price times quantity. Next, we look at costs, and costs are comprised of fixed and variable components. Fixed stays put, variable has a slope, and it looks like this. Total cost equals fixed of A plus BX. So we end up at the bottom. Profit equals price times volume minus variable cost per unit times volume minus A. Now, pretty simple and very intuitive, but it's very powerful for us to use it, and we're using it all the time when we're looking at product line profitability or whether to launch a product and at what price. So we can use this general purpose equation for many, many applications. We call CVP often break-even, but that break-even just means you're making zero profit. I think we want to make more than zero profit. So more descriptively, it's called the profit formula, or it's called cost volume profit relationships, but we all call it break-even for shorthand. All right. So here's a class exercise to look at how we would try to look at a general statement here and figure out what is the break-even point. In this particular case, we're using a format that we're going to come to understand as the contribution format. The reason we could tell is that the items here are variable versus fixed, and the subtotal here is not gross profit, it's contribution margin. So we're breaking out here sales of a million and 200,000 direct and 10,000 in indirect, etc. And we know we're making money. So if we want to take the break-even point, we can determine this. So let's do this. So I'm going to take this and copy it and put it in Excel. All right, so here, let's break it into the CVP formula just to give you how easy it is. So profit equals the price times the units minus the variable cost per unit times units minus the fixed cost. And I don't know if we knew the volume. Let's say we made 10,000 units sold equals. All right, so because of that, we can figure out our price. Price equals a million divided by the price. So it's $100 per unit. Next, we want to figure out the number of units, and that's the question mark for break even. Next, we want to look at the VC, variable cost per unit. And we know the variable cost was 210 divided by 10,000, 21. And fixed costs are given here at 625. So now we're ready to go. So the first question, going back here, is what is the break even? So break even equals, the profit is 0, 0 equals, the price is 100, 100 times X minus the variable cost of $21 times X minus 625,000. So we can solve this, and it's 0 equals, and we can subtract these two because they're both times X, so we get 79X minus 625. Now we're done. We could say X equals, and it'd be 625 divided by 79. And we can solve that now. Plus, so the answer is we would have to sell 624,921 units. So that is our break even. All right, next we say, how much do we need to sell to make $1 million? All right, that's called target profit. So we have a target profit of $1 million. And we have price of 100. Variable cost of 21. And fixed cost of 625. And we could do the same solving, just things we have done many times in algebra. So let's bring the numbers, the whole numbers together. So that's 1,625,000 on the left side of the equation. And then the right side we have 79x. And we can solve x equals, and it equals 1,625 divided by 79. So we would have to sell more, of course. How much more? We'd have to sell 20,569.62, rounded up to make sure you get over the money you need. So 20,570 units would earn us $1 million. So this very simple relationship of the profit equation is useful for break even and also for figuring out target profit and a bunch of other things as well. But let's just say those two as example. What we've been looking at is the difference between the income statement format of functional and contribution. So what happens in managerial, as we saw just recently, we have subtotals that are different from a GAAP-based statement called contribution, and we separate the fixed and variable costs. Whereas you recall in GAAP, in financial accounting, we go by function. That's why it's called functional. And for example, manufacturing, whether or not it's fixed or variable, it's manufacturing. Same thing with selling and administrative. Although most often it's fixed, it's not always fixed, and you just lump them together. And we have a term called gross margin or gross profit, which is revenue minus cost of goods sold. So this is an example of how you can get in trouble. So my goal is to make sure you don't get in trouble. So this is a set of financial statements we have for a company, a different company, and we're asked a couple of questions. First, what will be our profit if revenues double, right? So we have three alternatives. One is, let's assume that cost of goods sold is variable. That's the common assumption people make when they look at a financial statement, is that cost of goods sold is variable and overhead is not. Let's just stop there. Second is, let's get to true economics. If we dig in really deeply and see which ones move, which costs move as our volume doubles, then we can get to truth, economic truth. And then say, is there an accounting method that would use this as just a systematic way to give us the information we just were seeking? All right, so now I'm going to go back to Excel. First, I've just brought it into Excel so we can work with it. So what happens if we double revenues? Okay, I'm going to expand this section. If we double revenue, this number is twice of sales, right? So 500 goes to 1 million. Secondly, our cost of goods sold would double because we go from 400 to 800, doubling, which means, surprise, surprise, that our gross profit doubles from 100 to 200. If we assume that these costs stay the same, then we will lose 135. All right, so it's better. I'll just write better. But not too exciting, right? Now, but that may not be right. So let's go one level deeper to the economic level. So what's really happening? Well, we have to break out the cost behavior. So inside our cost of goods sold number of 400, we see that 100 is variable and 300 is fixed. We also see that in sales and marketing, 10,000 is variable and 50,000 is fixed. So our assumption of one being all variable, like COGS, or the other being all fixed, like sales and marketing, are both incorrect. So with this refinement, we can do stuff like this. Let's double the revenue, because that's the scenario. We double the variable costs, but we do not double this. So 300 stays the same. So now our margin goes from 100 up to 500. Why? Because the fixed overhead does not change, only the variable. So if we simply doubled our cost of goods sold, we're at 800. But if we break it apart more carefully, we'll see that if we doubled volume, it would only go up to 500. Big improvement. So we had more gross profit. Salaries are fine, they're fixed. Next, our depreciation, that's fine, that's fixed. Variable, however, doubles. So this one goes from 10,000 to 20. The fixed portion of sales and marketing doesn't change, so that stays the same at 50. And other costs, assume that stays the same. So our profit was much better. So gross profit is 500, 345. So this is now profitable. So it's a big difference when we're looking at doubling sales and still losing money, or doubling sales and breaking through and making a profit. Well, we don't really use economics as an explicit way we look at financial statements. We tend to look at accounting procedures. And this is, what if we use the contribution income approach for internal financials? I would never show these outside because it tells too much about our competitiveness. So this method, instead of having gross profit, I'll highlight this, we have contribution margin. And instead of having overall costs, operating costs, we have fixed costs. So here we have fixed costs that are separate from kind of overhead costs. And we have cost of goods sold here, which is different. Oops, I should keep it in blue. And we have variable costs. So those are the biggest differences, that this uses fixed and variable, and this uses kind of functional classifications. And the economics match. So this approach of the economic profit matches what would come up if we use the contribution income approach. So that's why I strongly recommend, particularly if you're a manufacturer, but even if you're not manufacturing, it's good to get your handle on fixed and variable costs, whatever your business is. So internal financial should be using the contribution income approach. All right, so summarizing chapter 4. First, accounting process. Even though you may not be a trained accountant or even like accounting, likely you're going to be involved in putting together the financial systems and financial reports, so you should keep it in the back of your head. Don't forget it all so soon. Next is, remember the 4 financial statements. They each have a purpose and they're going to be useful for you, particularly with external parties like bankers and investors. And third, managerial accounting has value too. We looked at 4 examples of pieces that are useful. One is the balanced scorecard, which creates metrics that can align the interests and activities inside your company. Second is understanding how costs behave, because that's essential for you understanding your economics, both in terms of profits as well as your capital extensions. Using that relationship, we can extend it to CVP, or cost volume profit, where we can do break even or target profit or a number of other simulations of how your business will do if certain things occur. And finally, there's a format for income statements internally that is superior, and that is the contribution income approach, or the contribution income statement. All right, so that's it for chapter 4. And hang in there. Chapter 5 is another review, this time of finance. Thanks. Bye.